Hello and a warm welcome to Econoday Unplugged on Tuesday, the 14th of September 2021. Terry Sheehan is on the US East Coast and I'm Jeremy Hawkins here in London. Earlier worries in financial markets that inflation might be getting out of hand have eased significantly over the last few months, and a number of central banks have now pressed the brake pedal on QE tapering or even rate hikes. Nonetheless, ahead of next week's policy announcements from the Fed, the Bank of England, and the Swiss National Bank, it will still probably be consumer prices that attract as much attention as anything else in this week's economic calendar. New price data from 5 of a G7 group of countries, as well as India, should provide some fresh clues about how long the current overshoot of inflation targets might last. That said, most central banks are still sticking to the view that current high rates will be only transitory, so it'll be important to keep an eye on a range of real economy updates too, notably including retail sales in both the US and the UK, which, if the forecasters have got it right, will provide some further indication of slowing economic activity. Okay then, so on the inflation front, Terry, a short while ago, you got the US CPI for August. What did it tell us?
Well, it told us that inflation is still high, but it seems to have peaked in July and is starting to come down in August. It's, of course, impossible to tell from just 1 month's data, but the annual increase was 5.3% overall, but we had a below expectations increase of 4.0 for the core, so that's excluding food and energy. So it looks like we may, in fact, be seeing some of that broad-based price pressure easing up. On the other hand, food and energy are important to U.S. consumers, and higher prices means less discretionary income for households. So still, it is a concern.
Okay, I think the other week we're talking about the latest employment report. I think you mentioned that within that, wage growth still seems to be pretty high. So
Yes.
Clearly we've got the various distortions coming due to the compositional effects, et cetera, et cetera. But do you think inflation can come down far in the near term, given what's happening in the wages market, or indeed what's happening to pipeline pressures elsewhere?
Well, so far we are not seeing wage pressures slip into inflation, although I'm sure the Fed is keeping a very close eye on that. A lot of it is simply recovery in wages after the worst of the pandemic and the massive layoffs in. But some of it appears to be competition for qualified workers. There was an interesting piece of data out last week from the US Commerce Department about business formations. Now, there was a huge jump in business formations in July of 2020 when many workers not having jobs started their own business, and that faded a bit. But since the start of the year, when mortgage interest rates hit historic lows in the US and housing prices started to increase substantially, it looks like many people are refinancing their homes, taking out some equity, and starting their own businesses again. So it may be that some of the worker shortage in the US is actually due to people starting their own businesses, not people who are unwilling to work.
Interesting. Now, presumably that in itself then suggests that economic growth should be that much higher than it would have been if it's just simply people dropping out of a labour force.
Exactly. And it's sort of a bromide here that, small businesses drive economic growth, in which case this large formations of new businesses probably are a good reason why we're seeing such strong growth in the US.
Interesting. Okay, well, if we stick with the real side of the economy then, what do we got? Tomorrow, Wednesday, we have the industrial production figures and retail sales on Friday. What are they expected to tell us?
Well, I think industrial production is going to be badly affected by the slowdowns in the motor vehicle production industry. There's just too many supply shortages for them to operate factories at the level they'd like to. So I think that's going to be very visible in the data. The other thing that's probably going to be quite visible is we've had an exceptionally hot summer here in the US, so it means a lot of electricity production. So that may offset some of the weakness in manufacturing, but we'll see. But retail sales could be very interesting because although motor vehicle sales, due to lack of supply, in large part, will be down for August. We may see other types of spending actually quite strong, in part because so many school districts have reopened in the US and people need clothes and school supplies for their children. So that could actually be, excluding motor vehicles, a pretty good report.
Okay, interesting. All right, moving on and just quickly from the real economy, I've got to ask you about the debt limit. I saw, was it, I think Janet Yellen, was it last week,
Yes.
warning the House Speaker, you know, spectre of US default, we can't have this drastic consequences, etc., etc. Where do we stand on the debt limit at the moment?
Well, we're still in the Treasury doing extraordinary measures, and the political wrangling that involves getting the debt limit passed at a higher level. There are concerns that we're going to have another 11th hour battle over this, but it is in fact unthinkable that the US would default on its loan. Nonetheless, Treasury is probably reviving a lot of the work they did in prior debt limit crises about, you know, what are the options that they can take if it should come to that. Hopefully it won't, but given the contentious political environment here, it's probably going to be a last minute thing.
Okay, and in terms of just simply implications for Econoday's calendar, at what stage would we get to the point whereby it could have implications for, you know, changes to release dates for individual indicators and so forth?
Well, we won't see any changes to individual indicators unless there's an total government shutdown. But what we may see is some changes to the Treasury offering calendar as they have to adjust sizes of their whatever they're selling in terms of bills, notes, or bonds. And they may in fact end up rescheduling some of those sales just because they can't issue that kind of debt.
Right. Okay, so when is sort of a last minute? Is it kind of somewhere around mid-October time when they finally have to get this thing through, if it's going to happen, or is it beyond that?
Well, Yellen is saying October right now. Some of that's going to depend on what happens around mid-September, because September 15 is a tax payment deadline. So if there is more tax payments coming into the Treasury, they may be able to push out that deadline. On the other hand, if there are fewer than expected, then they may have to shorten
Right. Yeah, sure. Okay, another one, keep an eye on.
Yes.
Right, anything else from your side?
No, I think there's just everybody's on tenterhooks right now about the outcome of the next FOMC meeting.
Right. Which we will be discussing at some length next week. So do tune in then, folks. Okay, excellent.
And we will be getting no more information from Fed policymakers because they are in their communications blackout period. So that's why the uncertainty right now.
Yeah, sure. Okay, excellent. Thanks for that, Terry. So across to, well, my part or bits for pieces of the world I look at, last week, I should say, main news was the ECB meeting on Thursday when, as widely expected, there's no change in interest rates. So effectively zero interest rates on the REFI, and the deposit rate stands at still minus 0.5%, or the long-standing asset purchase program. The only move which had been largely expected was on the pandemic emergency purchase program, the other arm of the total quantitative easing package. And there we saw what I suppose best describes a little bit of tapering, or if we want to quote Christine Lagarde, she maintains it wasn't actually tapering at all, but a recalibration of the PEP, whatever that might mean, because at the end of the day, it still comes down to the fact they'll be buying fewer assets than they were previously. But essentially, all the ECB did last week was to, I guess, kind of indicate that they feel a little bit more confident about the way the economy is performing at the moment, to the extent that they felt they could reduce the quantity of assets being bought on a monthly basis. Now, folks, remember the increase which are introduced in March was due, in terms of PEP purchases, was due to expire at the end of this month. So they really had to make up their mind what they're they're going to do with it. In the end, they decided just to reduce it moderately, whatever that might actually mean. And this moderately lower pace of asset purchase will compared with what they described as a significant increase in asset purchases in the second and third quarter. So I guess taken at face value, the language kind of suggests that the reduction in purchase will only partially reverse the March's increase. Remains to be seen, but certainly it does seem that whatever the reduction might be, it won't take new monthly purchase to anything less than we saw at the start of this year. So if you like a worst case for markets, it's going to be the case that we simply are where we were. Okay, in terms of forecasts, well, they do actually show slightly higher inflation numbers now, and indeed marginally stronger growth. But I guess the bottom line to this is, if you look out towards the end of the forecast, both the headline and core HICP, so the harmonized index consumer prices, their headline and core inflation rates are both only 1.5% in 2023. So in other words, below target. So for choice, I suspect that the decision to actually just trim pet purchase a little bit really was just a compromise between the hawks, who are quite clearly becoming increasingly agitated by rising inflation, and the doves, who still see COVID as being a major threat to the real economy. Bottom line, I think, is that in the main, the ECB is still dovish, and it certainly wants to see some further significant fall in unemployment and indeed sustained higher underlying inflation before really starting to even contemplate the idea of pulling the plug completely on quantitative easing. I see the markets took it pretty well, so I guess you've got to say in terms of selling it, the ECB did a good job. There was certainly no signs of any taper tantrums there. So so far, I guess, so good as far as the ECB is concerned, but it really does mean that ECB interest rates, indeed Eurozone interest rates, are going to remain very low for a long time yet. So if you're looking for a funding currency, then I guess the euro will continue to be one of those currencies of choice. What else I should mention from this side, in terms of inflation, we'll be getting the final August inflation numbers out at the back end of this week. That should just confirm a jump in headline inflation to 3% from 2.2%, and the core rate up to 1.6% after 0.7%. So headline rate above the 2% target, core rate still low. But of course, as we've talked about in the past, we've got the German VAT cut from last year and these seasonal sales distortions, which continue to make it pretty near impossible to really interpret what's going on with these data. And I suppose what I would suggest is, in some ways, although we don't have a core rate ex-tax, they do provide in the final data an ex-tax inflation number, which will at least give you some kind of idea what might have happened had it not been for distortions coming through the VAT reduction out of Germany. So do keep an eye on that. Should also mention, while I'm talking about the Eurozone, the German elections are upcoming. They're due on September the 26th. Although in practice, the German elections tend to produce fairly broad brush coalition government, there have been some fairly sharp swings in the opinion polls over the last couple of weeks or so, and very much now suggesting that the next coalition could well be led by the Social Democrats. So that would be replacing Angela Merkel's Christian Democrats. So we could see a swift to the left, and that could have implications perhaps for what's going to happen to fiscal policy in Germany and indeed the Eurozone bloc as a whole over the course of coming years. And it does seem as if some concern about what's going to happen to German politics has been undermining the euro to some extent as well. And what else we got from my side? I'm going to mention the UK. We had confirmation of confirmation of it turned out to be a much sharper slowdown in economic growth than anticipated in July. The monthly number there showed an increase of just 0.1% on the month. And essentially that just came out of the erratic mining and quarrying sector. There was no growth at all in services. Manufacturing output was also flat. So that really, in terms of overall GDP, was its worst performance since what it last contracted back in January time. So certainly a clear indication then that amongst the major countries, it does seem that the UK economy might be slowing rather quicker than a lot of the others. Labour market data we had out earlier on this morning suggests that at least the economy is still growing, but it also highlighted labour shortages with a record number of vacancies being published today, which really does suggest that there's a number of companies now and firms are really struggling to get hold of skilled workers. On the inflation front, we have the August CPI for the UK. That's due out tomorrow. And in line with so many other countries, expected to be high. In fact, expect to see a big jump up to about a 2.9% year-on-year headline rate from 2% previously. However, with all these distortions, I've got to mention it, we had a cut in UK VAT middle of last year, which led to prices actually declining, half a percentage point on the month in August 2020. That's going to feed straight through into tomorrow's number, so it kind of almost guarantees we're going to see a hefty jump. It's just a case of how high that's going to be, but the Bank of England will certainly be looking through that. Nonetheless, inflation has been rising quite a while in the UK now, as we saw from this morning's labour market report. Wages growth, and as we talked about, as Terry was talking about earlier, but there's distortions in this, but nonetheless it's well up at 8.3% at the moment on an annual basis. So it does suggest that labour market is providing some potential problems for the Bank of England on the inflation front further out. And if we stick with inflation, since it's very much the theme at the moment, coming out of Canada tomorrow, we'll get the August inflation numbers there as well, and that's expected to see inflation up to 3.9% from 3.7, and that will be its highest rate since 2003, and indeed its fourth consecutive print above target. Already in July, we had the average of the three core rates that the Bank of Canada looks at, peaking at 2.5%, and that was their fastest print since 2009. Now, all that said, the Bank of Canada duly joined the group of central banks tapering the taper, we can say that, last week, when they opted not to change the current 2 billion Canadian dollars per week quantitative easing purchases, and that was due to the big hit they had from COVID in second quarter GDP. However, crucially within their report, they still intimated that they continue to expect the first rate hike, so actual proper tightening in terms of higher interest rates, to take place in the second quarter of next year. So that's unchanged from their previous view. So very much consistent with the idea that they do see the effects from COVID being only temporary, and underlying strength remains in place. That said, it is worth mentioning that COVID cases are still rising quite sharply in Canada. And indeed, President Trudeau was Prime Minister President Trudeau, wasn't it, was warning about more lockdowns without more vaccinations. So it's going to be an interesting call to see what happens in Canada at the moment. It does look as if markets, by and large, are expecting tapering to come back sooner rather than later. But depending upon the COVID situation, it may be we'll have to wait a little bit longer than perhaps financial markets are currently discounting. I should mention India. We had the August inflation numbers there, which, akin to the States, actually softened a little bit. We had headline inflation there coming in at 5.3%, down from 5.6%, and expected 5.7%. So that's its third consecutive fall. And the second month, we've had it in the target range of 2 to 6%. In any event, the RBI's already made perfectly plain that it's much more concerned about the recovery in the real economy at the moment. So it probably takes something a good deal harder than that. We're going to start to see the RBI ease policy in any shape or form. Out of Australia, I mean, lockdowns have become a feature in the Aussie economy in the third quarter, and the Reserve Bank of Australia have just come out, and clearly they stepped off their tapering path as well now, and they'll be holding current asset purchase until well into next year. But they've also come out now and intimated that they see at least a 2% contraction in third quarter GDP due to COVID. So again, it just highlights the fact that, however you try to slice it, COVID is still having an impact upon the way global economy is performing at the moment, particularly in the southern hemisphere, where the numbers remain pretty high, and lockdowns, of course, still very much a feature. I should mention, I suppose, also New Zealand will get the second quarter GDP numbers out of Kiwi tomorrow. They're expected strong, up 1.2% on a quarter. So that's nearly a not 5% annualized rate, which is very good momentum indeed. But of course, like its Antipodean neighbour, the third quarter will also be hit by lockdowns. That's why the RBNZ didn't tighten last month. But from everything they're still saying, and the way the market's pricing things, still looking for an interest rate hike there as soon as next month, October the 5th being their next meeting. What else from my side? Not a lot, I think, really. I guess, I don't know, from my point of view, I'll just point out that, I mean, supply line developments currently are not really pointing to any meaningful let up in inflationary pressures. Generally, I think, certainly as far as Europe's concerned anyway. In fact, if anything, the current combination of bad weather and COVID means that disruptions are probably getting worse. Notably in China, Shanghai, the world's busiest port, recently had to close due to a typhoon, as did a number of its airports. And that typhoon is now on its way to another of the world's largest exporters, South Korea. So central banks might see above target inflation as only transitory, but with many semiconductor manufacturers now also warning that shortages will last into 2022, I can't help but wonder if it might prove a little bit longer than that. Right, enough prattling from me. Terry, you're happy?
I'm happy.
So long as the lady's happy, that is good enough for me. So I guess, one of these days we'll actually do a podcast which doesn't mention COVID, but that doesn't look likely to happen for some while yet. Still, there's plenty of other key data and events to impact investor sentiment. And of course, you can keep up to date with all of those in Econoday's global economic calendar. On behalf of Terry and me, thanks very much for listening as always, and we'll be back next week. We'll see you then.